Like Jason said, we've got an important Fed meeting tomorrow. So, I don't want to get ahead of myself, but I think a lot of you that follow the Fed, follow interest rates, follow the news and financial news and markets, we kind of know what's coming tomorrow. We're more likely than not going to get another 25 basis point rate cut. I think the market's pricing at about a 100% chance of a 25 basis point rate cut. So, but before we kind of get to that future conversation, let's kind of talk about where we've been, right? So I just have a couple slides on the markets, not a big econ presentation, but we got to know where we've been and where we could potentially be going, right? Where have we been, right? We had the pandemic, 2020, 2020, 21, ultra low rate environment, historic levels of liquidity, making loans 4%, sub 4%, buying bonds 1%, less than 1%, maybe 1.5%, earning 5, 10 basis points on cash. A drastically different environment from what we've been operating in the last several years. So we got the 525 basis points of rate hikes that you can kind of see over here on this right-hand graph. And then, of course, we held there for well over a year. And then we've started to see these first rounds of cuts, right? You go back about 13 months ago, September of 2024, we got our first 50 basis point rate cut. And of course, that was a big deal, right? A lot of you, your cost of funds was going through the roof, margins were compressing. We were hoping and praying and begging for some sort of rate cuts and rate relief, specifically to help our margin expand or at least stop contracting as much as it did. Then we got another 25 basis point rate cut in November of last year, and then another 25 in December. And then the Fed went on pause for not the entire course of this year, but until about 6 weeks ago. The last Fed meeting, we got another 25 basis points. And like I mentioned a couple of minutes ago, we should get another 25 basis points tomorrow, and then we should most likely get another 25 basis points at the December meeting, which I believe is on December 10th. Okay, so again, very aggressive tightening cycle. We all kind of know that put our balance sheets on edge, put interest rate risk, like Jason said, into the forefront from the regulatory perspective, and liquidity risk as well, right? We're not talking a lot about liquidity risk on this webinar, but it's hard to decouple interest rate risk and liquidity risk, especially with the rising deposit costs and pressure on deposits. So let's go back to the yield curve real quick. So this is the yield curve from about a month, a little over a month before the Fed started cutting rates in September of 2024. A very, very inverted yield curve. This was not a favorable yield curve for community institutions, banks and credit unions, right? We were competing with a lot of money market mutual funds, a lot of CD specials that were priced at or near this front part of the curve. You could go to Fidelity, Schwab, Vanguard, whatever broker you worked with, and you could park your money in a money market mutual fund and earn well above 5%. And that was all because the front of the curve, 1-month treasury bills were above that 525. Now, the Fed controls that front end of the curve, right? So with the now 125 basis points of rate cuts that we've received since September of last year, we've seen that front end of the curve come down. I ran this curve the other day. We were about at 4%. All right. So I wouldn't call this the most steep yield curve that we've ever seen in maybe our lifetime and in our careers, but it is clearly a relief from this very inverted and prolonged inversion of the yield curve that put a lot of pressure on our margins. So, and with the future rate cuts that I referenced coming tomorrow and then in December and potentially in 2026, we should get movement downward on the front end of the curve. The question is always, how does the long end of the curve behave or react? And that's going to really be driven by the market's expectations for long-term growth and inflation and the longer path of interest rates. And alongside that conversation, here's the 10-year treasury. It has been bouncing right over the last few weeks, right at that 4% level. It's trying to figure out what the heck's going on with this economy, what's going on with the consumer price index and PCE and inflation. And those of you that kind of follow the economic releases, you may have noticed we really haven't gotten a lot of economic data in the last 5 or 6 weeks because of the government shutdown. We did get the consumer price index late last week, and they had to do that as a result of Social Security and the cost of living adjustments. But that's just a little outline of where we've been, where the yield curve is. And then last thing I'll show you guys, some of you have seen this. This is the dot plot. This is the Federal Open Market Committee. Each voting member gets his or her own dot. And it's basically where do we think the Fed funds rate should be or will be in the coming years, including this longer term run. And really the takeaway is this. What analysts like to look at is the median or middle dot, right? And that's reflected by this green line. So the median dot is calling for 50 basis points more of cuts between now and the end of the year. This dot plot came out at the last meeting in September. Okay, so that would put, the upper bound at 375 and the lower bound at 350. Now, what does the market think for next year? The market's more dovish. The market's thinking we're going to get to 3% or even below 3% by the end of next year. So the market's more dovish than the median dot. But again, you can see the dispersion of the dots. It gets pretty wide the further out you go. So I think big picture, we're not here as financial institutions to try to make a wholesale bet with our balance sheet one way or another with interest rates, right? We are risk managers, right? We use these interest rate risk models to make sure we don't have too much risk to rising rates or falling rates. But at the same time, I do think it's important for ALCOs across the country to have a little bit of a rate bias, right? So we can maybe make some little tweaks with the balance sheet to shore up any potential risk a little bit more for one rate outcome versus the other. And I think we can all agree that the likelihood of lower rates from here is greater than the likelihood of higher rates from here. And the market's telling us that. The Fed's telling us they want to get rates back down to 3%. Now, the speed and magnitude of these rate cuts, it's going to be data driven, assuming the government gets reopened and we get some of these data points. But it's going to be data driven and it's going to be economic driven. If we have a recession, I'd say all bets are off. Rates are going to fall maybe more quickly than what the Fed or the market anticipates. But if inflation reaccelerates or holds steady, or the labor market looks a little bit better than it has, maybe that path could be a little bit slower downward. So either way, again, falling rate risk is something that we've been talking with our clients a lot, especially after the last several years of a heightened focus on the rising interest rate risk environment. All right, let's talk about current asset liability management trends. All right, so I'm going to show about 5 or 6 graphs, and we do this every quarter at the Baker Group. We do the Bank Trends webinar. I go through, I look at call report data for what we deem community banks. So less than $10 billion in assets. We look at averages, we look at trends, we look at current levels, we make comments, and so forth. And so I'm going to share a few of these with you. Now, keep in mind, this data is only current as of the second quarter. I didn't quite have the third quarter data all bustled up and bundled up for you guys because it's not due until the end of the week, and it usually takes a week or so for us to aggregate. But of course, loan to asset ratios greatly declined during the pandemic as we saw a lot of asset growth because of the stimulus and the liquidity and just the sheer asset growth that occurred. And then we climbed out of that pretty steadily over the last several years, sitting at a 68.5% loan to asset ratio. Alongside that same period, so anytime we see a reduction in loans, we typically see a rise in the size of bond portfolios. And that was at a time, you all remember, it was about 4 or 5 years ago, ultra low rate environment, right? Banks bought a lot of bonds, and it was because we were just drowning in liquidity, right? And sure, in hindsight, a lot of you might be like, oh, I wish I wouldn't have bought so many bonds. They've been underwater and they're low yielding, right? But you got to remember, it was all relative at the time. The other option was to stick it in this green line, which is interest-bearing balances, excess balance accounts at the Fed funds market, sort of a cash liquidity position. That was only earning us 5, 8, 10, 15 basis points. So when I say it's all relative, we could earn 1.25%, 1.5% in the bond portfolio, which we laugh at now with yields being closer to that 4% or plus 4% level. But it was, again, it's all relative, a much different rate environment than we've been experiencing. Then once the Fed started raising rates, a lot of these trends started to go the opposite direction. Loans grew pretty quickly. The bond portfolio started to shrink as we weren't buying as many bonds, and our cash liquidity levels started to dwindle. All right, let's look at margins, right? Margins are the lifeblood, the core earnings of community institutions across the country. And margins have seen just tremendous amount of volatility and noise and change since the pandemic. Pre-pandemic, the average community bank was about 380 margin, declined all the way down within about 2 years to a 320. And this little sidestep right here, some of you remember the PPP loan program. A lot of fee income was brought in from that. That helped our margins not go into a complete free fall. So we lost 60 basis points of margin during the pandemic, right? Performance, anytime margin compresses that much, overall performance, return on assets, net income is going to falter. Then in 2022, the Fed starts raising rates very aggressively. Here's the effective Fed funds rate, right? We all remember that 75 basis points, another 75, another 75. And it was great. It was great for our margins, largely because we didn't have to increase our liability and deposit costs. We still had liquidity. Nobody was really running those CD specials initially in the rate hikes. Money market mutual funds weren't really sought after until we got to a certain level and point. Probably once we got to 2.5% or 3% on the funds rate, that's when deposit competition really started to ramp up near the end of 23. Then margin compression kicked in, and then more recently, we've seen some margin expansion with these rate cuts that we started seeing in September of 2024. So when we break down margin, we can see yield on earning assets and cost of funds. And I think we all know the cost of funds story, right? I just mentioned it. Cost of funds, we lag and drag the Fed early in the tightening cycle, right? And then it started to really accelerate upward. And that cost of funds beta for the cycle was about 37%. Now remember, cost of funds, when I do this analysis, it's total interest expense. So it's not just what we're paying on deposits, it's what we're paying on all liabilities. So if you were an institution that had a lot of wholesale funding, home loan advances, or bank term funding program, or any other sort of borrowings, that is also factored into here, and your cost of funds might be higher than this peer group. So we got relief in our cost of funds. Now the most recent first quarter to second quarter, we were flat on cost of funds. And that was really just a function of we didn't get any rate cuts until about 6 weeks ago. And so those initial rate cuts at the end of last year, we were able to reduce our CD cost, some of our non-maturity deposit costs, some of our wholesale funding costs. But then with no further rate cuts until about 6 weeks ago, we saw a flat or no change cost of funds. So more rate cuts. The one 6 weeks ago, we should get another one tomorrow, and then another one in 6 weeks. We should continue to see some downward trend on cost of funds. So then the focus becomes maintaining yield, right? We got to maintain yield. I think this first 100 basis points that we got at the latter half of last year didn't really hurt our margin. I think a lot of that was because we still had a lot of COVID era loans that were repricing from, say, 3.5% or 4% or 4.5% up to the market rates, because a lot of institutions will do commercial loans or commercial real estate loans on a 5-year fixed period, and then maybe it floats after that, or it has a balloon payment. So we still had a lot of low yielding loans, lower yielding bonds that have finally had the opportunity to reprice in these higher rate scenarios. But my concern is with future rate cuts, how well are we going to be able to protect margin and maintain yield? And of course, I think that can be done prudently with the bond portfolio, and somewhat with the loan portfolio. It's a little more challenging having a customer on the other end of that transaction. So that's kind of where we are when we look at call report data related to margin and what I would call earnings at risk or our short-term interest rate risk position. And then liability mix. Again, anytime we see a low rate environment, our percentage of non-maturity deposits increases greatly. And then when we see a rising rate environment, we see that disintermediation, where basically more dollars go into CDs, less into non-maturity deposits. And then down here, we see borrowings take a little bit of a spike, wholesale funding use, and then it starts to come down a little bit with these falling rate scenarios. So I do want to mention this because Jake and I are both going to talk about this, but non-maturity deposits are probably the most focused on interest rate risk assumption in your model. And the reason is it's right in front of you. It's we get a ton of our funding and a ton of our liabilities from non-maturity deposits. Now, are we at the peaks from a few years ago? No, but 60% is a high level. And if you went back to the before the financial crisis, so now, goodness, what is it, about 18, 19 years ago, these lines were a lot closer together. But that prolonged low interest rate environment, 2009 to 2015, and then of course COVID really accelerated the amount of non-maturity deposits. So that is one of the fundamental reasons why non-maturity deposits are so focused on the assumption side of interest rate risk modeling. The other two are we set the rate as an ALCO or a committee on how aggressive we're going to be on deposits. And we also have to make an assumption about the duration and longevity of those deposits. What about deposit growth or lack thereof? Of course, here's the blowout in non-maturity deposits for the industry. Trillions of dollars of stimulus pumped into the economy. A lot of it landed on our bank and credit union balance sheets. Then when the Fed started raising rates, takes liquidity out of the system, puts pressure on deposits, deposit competition shows up, and we start to see a decline in our deposit levels. Now, good news is the last couple of years that has moderated. Now, I will say this: I'm very fortunate to speak across the country to people in the industry, and I always ask, "What's your biggest concern for your bank for the next 12 months?" I've asked it for the last 12 to 18 months, and it's consistently liquidity and deposits. So we're, as my mother would say, we're not out of the woods yet, right? We're still concerned about liquidity. We're still concerned about deposits, but the pressures have eased. We're not seeing 5% CD specials. We're seeing low fours, upper threes. But again, we're not completely out of the woods there. All right, let's keep going. Again, we've got different sections for you guys. Just wanted to set the stage with where interest rates have been, where we think they may go, and then some industry trends. Let's talk a little bit more about industry trends, but now let's kind of dial it into the interest rate risk modeling aspect. Jake and I are interest rate risk nerds. We geek out on this stuff. This comes out twice a year. It's the OCC interest rate risk statistics. And we just got an updated one for the fall of this year. So it's hot off the press. The report represents 828 banks, a lot of different asset sizes in here. So this is not just community banks. It's not just less than 10 billion. You've got very small banks, kind of medium-sized community banks, and then over 10 billion. Aggregate them together, you're looking at a peer group of OCC primary regulated banks. Some of you on the call are primary regulated by the OCC, so your data is in here. Of course, it's all anonymous. We couldn't isolate it, but there's about 828 institutions in here. Okay, so let's just look at a few trends. There's probably, I don't even know, Jake, there's probably 30 pages on this report, give or take, but there's a lot of data. I'm just going to highlight some of it to make some observations about interest rate risk. So remember, we measure interest rate risk as an industry really twofold: short-term interest rate risk, long-term interest rate risk. Okay, earnings at risk is typically done over 12 and 24 months, and then long-term is going to be beyond 24 months, done by economic value of equity. So what do all 828 banks look like from kind of a statistical distribution with their earnings at risk over 12 months? Well, the short of it is this: the median bank has some exposure to falling rates. It's not a huge percentage, 1% in a down 100, 3% in a down 200. They don't have a down 300 or down 400. I think we can reasonably say and expect that if we did, these numbers would get bigger. So it highlights that the median bank in this peer group and really in the industry has some exposure to falling rates. Of course, some bigger than others, right? And then some have some gains. Now, we all know this. All of these outputs are very assumption driven. So our models are only as good as the inputs. The old garbage in, garbage out saying applies very specifically to interest rate risk modeling. What about EVE? Well, EVE looks pretty good when rates go down. EVE, we do see some risk, some continued risk if we shock rates up. Now remember, an up 400 shock from here, probably not very realistic in the short term. I would never say never, right? You coming out of the COVID, we saw over 500 basis points of movement from the Fed. But from here, kind of got a 4%, 425 Fed funds rate, this is an additional 400 basis points of shock. So the average or median institution sees some contraction in their EV, which is to be expected, right? Most institutions on this call, most in the industry, have a little bit longer asset duration than liability duration. So let's look at these same statistics, but let's trend them out. So the OCC started releasing this consistently starting in the fall of 2020. So we've got several reports. What is this, about 10 different reports, semi-annual reports on these interest rate risk statistics. So you look at earnings at risk over 12 months, and the median bank going into this first rising rate and the first portion of the rising rate environment in 21 and 22, it started in March of 22, their model said, hey, we welcome rising interest rates. Look, we're going to do better. We're going to go up 5%, 10% in these more severe upward movements. And to be honest, I'm going to skip back a little bit. It played out pretty well in the early stages. But then what caught up with us? The cost of funds, right? Those beta factors were probably at a certain point were a little bit low, right? We probably saw some institutions adjust their beta factors, feel their cost of funds really rise, and start to show that, look, further rate rises from where we are currently, and right, like in spring of 23, we had already seen plenty of interest rates, so another 300 or 400 up, we weren't going to project as much margin expansion. And then along the lines, nobody was really focused on falling rates, but we've consistently had some level of falling rate exposure as it's calculated by this data with some contraction here. What about EVE? Quite the whipsaw here. EVE looked very favorable before rates started rising. A lot of this was we were very asset sensitive. We had a lot of cash liquidity. We had a high level of non-maturity deposits, which we typically model as maybe a 4, 5, 6-year average life, some level of duration. Then rates started to rise. Our bond portfolio started to depreciate in value. Our loan portfolio, those 4% loans that were locked out from repricing for 4 or 5 years, those lost value. I realize we don't have to do mark-to-market accounting for our loan portfolio, but that's essentially what EVE is doing. It's taking the fair value of those assets less the fair value of those liabilities. So we saw asset durations, some of them extended with lack of cash flow and lack of call options. So we saw pressure on our EVE, and a lot of banks, the median bank had some EVE risk and exposure. Now we're kind of in this, I don't want to say it's a weird period, but now we're a lot more focused, or we should be a lot more focused on our risk to falling rates. But I always like to say interest rate risk is a two-sided coin. In order to reduce our exposure to falling rates, when we look at it from an earnings at risk perspective, we typically have to do that at a detriment to our rising rate EVE position, right? Because in order to improve our rising rate EVE position, ALM 101 says shorter assets, longer liabilities. All right. Well, what does ALM 101 say? How do we reduce falling interest rate risk? It's the exact opposite. Shorter liabilities, longer assets, right? So they work against one another. So I don't want to say we need to take our eye off the ball on our rising rate EVE scenarios, but we've got to understand the dynamic, and maybe that's some board education or ALCO education, but in order to reduce our falling interest rate risk, it typically comes at a cost to a rising rate EVE position. All right, last one from this section, OCC interest rate statistics peer data, specifically with non-maturity deposit assumptions. I'm not going to spend a lot of time on these, but this is more of a resource slide for you if you're maybe doing an annual assumption review, or you want to kind of compare and contrast where your assumptions are versus this 800 plus peer group. Here we go, specifically with non-maturity deposits, betas, falling rate betas, rising rate betas, average lives. Now, I think a lot of you know this, these assumptions need to be institution specific, right? So you don't want to just come in here and, all right, well, we'll just take the median and put it into our model and we're good to go. No, but I mean, I think this is a good kind of starting point. or a little bit of a quick check. Are we in the ballpark with the average or median, or are we not? Are we higher? Are we lower? And if we're higher or lower, how do we support that? Right? Are we in a highly competitive market? Right? I'm just thinking top of mind. I did an ALCO with one of our clients in Houston. They've got high betas, and they should. They have a high cost of funds. They're running CD specials. They're in a very competitive market in in the Houston MSA, right? Okay, let's kind of keep going here. Stress and sensitivity testing. I know Jake's going to chime in here on some of these slides as he's got really good insight on these best practices. So stress and sensitivity testing, right? Now, regardless of who you work with on the ALM side, regardless of what vendor, whether you work with Baker Group or the other vendors out there, and not to use just a lame pun, but I'm going to do it. I can't stress enough the need for stress testing. This is something that 5, 6, 7, 8 years ago flew a little under the radar in the regulatory realm. It doesn't anymore. DIC request lists for exams. I've seen OCC, I've seen Fed Reserve. They all want, what have you done with stress or sensitivity testing? So let's take just a few slides to just remind you, if you already know about this, or to introduce it to you. Why do we do stress testing within our asset liability and interest rate risk model? It helps us plan against these unlikely events. What if our deposit betas are much too low for the competitive environment, right? And you know, what does that look like? What does that worst case, what does that high impact, low probability scenario look like with respect to our earnings at risk and EVE? It allows us to refine model assumptions. I think that's kind of the sensitivity component. What are the key assumptions in the model? And stress or sensitivity testing allows us to identify that. I think for most of you, non-maturity deposits fit that mold. But for some of you, it may get a little bit more institution specific once you start doing that stress and sensitivity testing, which sensitivity testing is just changing one or two key assumptions of the model, seeing how much it moves the outputs. And depending on the assumption, it may move them a lot or it may move them less to a lesser degree. It helps the institution make informed decisions, right? It might say, hey, maybe we shouldn't run that CD special, or maybe we shouldn't run that type of loan product for one reason or another, or we shouldn't buy this type of investment, or we should buy this type of investment, right? Our asset liability management model should be seen as a tool. And then last but not least, I had to throw in the old examiner check the box, right? I spent 6 years in the first part of my career as a FDIC examiner, so I'm still a recovering examiner. But examiners like to see a proactive stress testing process, right? I said it on the front end of this slide. There is a regulatory expectation that you have stress and sensitivity testing done periodically within your model. So how do we identify these appropriate stress tests, right? One thing I like to say is get creative. You know, look at past rate cycles and bubbles. We've got a very recent aggressive rate cycle to look to that wasn't that long ago. How did our deposits behave or not behave? How did other things look? How did our loan portfolio behave or not behave, right? You know, look at our balance sheet changes. Some of you, I'm going to skip back a little bit. Some of you saw a big change in your liability mix. You went from 72% to 50% NMDs and a huge rise in CDs, right? Look at your liability mix changes. That could be some low-hanging fruit when we're trying to do a simulation or a stress test, like a migration analysis. What may happen over the next 12 months? What if the Fed cuts rates more aggressively than we think? What if we have sticky depositors from a yield standpoint, meaning we have rate-sensitive depositors and our liquidity is not that strong, and we have to not move our rates down as much. We can't be as rate sensitive as rates fall. What about our loan pay downs, right? So again, get creative, have these conversations with the ALCO. What makes our balance sheet more unique than the credit union or bank down the street, right? Do we have different exposures, different nuances, different business lines or strategies or customer base kind of nuances or specifics that might make us a little different? Again, get creative. And I would apply this same logic to when you're doing liquidity stress testing, right? You know, what makes us unique? What would put us in a pinch or a perfect storm for liquidity pressures? All right, so I wanted to share with you guys what we do for our clients. So I mentioned I worked with Jake for about, excuse me, I worked with Jake for about 8.5 years. He was a senior analyst in our interest rate risk department. So he knows a lot about this, but we were recommending to our clients for a number of years, you've got to run stress and sensitivity tests. This is pre-COVID. And we were doing it more on an ad hoc basis. We had ones that we would recommend. Some of our clients would do 2 a year. Some would wait till their exam letter came in and the request letter came in and said, "Hey, I want to hit 4 on the exam as of date report." And so we kind of said, "Look, we're running 700 institutions on a quarterly basis, which we're very, very happy to do, but let's make it more efficient for us as well as more meaningful for our clients." So what we decided to do is we said, let's put you on a calendar quarterly schedule. In the first quarter, we're going to do this stress test. In the second quarter, we're going to do this stress. In the third, we're going to do this. In the fourth, we're going to do this. That was a much more digestible, planned out approach. Okay. And it's been very well received from our clients as well as the regulators. And I realize not all of you on the webinar work with us, and that's not the point. I'm encouraging you, if you're not doing stress or sensitivity testing, borrow some of these ideas. Changing your betas, reducing your loan prepays or increasing them depending on the rate scenario. CD betas, cutting those down, showing we're not going to be as rate sensitive as rates fall. Doing a migration, or no, that's not a migration, I'm sorry. Cutting our average lives down from 5 years to 2 years, putting pressure on our EVE. Jake, did you have a comment on this? I'm sorry.
Yeah, I was going to say, when it comes to being proactive, I think this is really best practice. I think number one or first, I would say getting these results in front of your ALCO and board on a regular basis, just more often than once per year, is really best practice and can add a lot for them. Really get them used to seeing, what these tests, how they shock your results. And then two, on that same note, I think it's better to change up your assumptions and really shock your earnings and capital at risk on a regular quarterly basis rather than just doing it all at once and only seeing how one date's worth of results look.
Yeah.
I think you'll know more about the risk that is in your model and on your balance sheet if you're testing your results more often.
Yeah, I love that. That is one little piece of former examiner advice. Remember, exams, the time frame is not just what did you do on the current quarter or the financial as of date that the examiners told you they're looking at. It's what have you done since the last exam, the previous exam. And for some of you, that's 18 months. For some of you, that's 12 months, depending on size, rating, and all of that. But I encourage you to not just wait until the last minute and try to knock all these out, because I don't think it's meaningful to the ALCO process, right? How is your board going to look at 7 different reports and digest some of your ALCO? So, yeah, good color there, Jake. All right, let's keep going, guys. Again, a lot of different topics for you guys, a lot to talk about. Assumptions and back testing, right? We've got to have institution-specific assumptions that are documented, right? So there's a handful of ways to do that. One approach that the Baker Group really likes to recommend, and it's a little more data intensive, is what's called an open close study. So open close studies are going to, what we're after here is how long, what is our average life, what's our decay rate for our non-maturity deposits. It's that simple. It's a critical assumption because of the higher weight, the higher volume of NMDs, and they have a big impact on the economic value of equity analysis, right? So all we do for our clients is we say, hey, give us kind of a download of data. I don't need customer specifics. I just need the type of product, when the account was open, the close date. Of course, if it's still open, there's no close date, so it's blank. I love an average balance, so we can kind of weight towards average balance or the number of accounts. We've got some flexibility there. And then we come up with an average life. And I wish I could say then we're done and the process is over and have a great week. It's not that simple, and I'll explain why. A lot of our clients, a lot of you on the call, if we ran an open close study for you, you're going to come up with a 10, 12, 15-year average life for your NMDs. And you're like, well, that's institution specific. And I don't disagree, but regulators like a little bit more conservative approach. They don't want us to mask potential interest rate risk with a really long non-maturity deposit average life or a low decay rate, right? So we are a very conservative firm at the Baker Group, especially with interest rate risk modeling. So we might factor adjust. We might say, let's just take 40% of your average life calc or 50%. Now, this is more the art than the science portion, right? There's no magic number. We've just got to kind of say, hey, look, we're going to be a little bit more conservative. Maybe there's some qualitative factors we can point to. This data goes back 30 years. However, there's 4 more bank branches or 4 more credit unions in our market now that make it more competitive. Maybe our average customer is more rate sensitive, right? There's those qualitative factors that we can document, discuss that will point to why we might factor adjust and be more conservative with our average life. And then what about betas, right? Betas are the other critical assumption within non-maturity deposits. And all a beta is how are we going to reprice our non-maturity deposit accounts versus the market? And beta applies to all assets and liabilities, right? Loans, bonds, but it's more focused on the non-maturity deposit because it's an administered rate that we set as an ALCO or any other deposit committee. And it's a big driver, again, volume, right? So we have this call report based analysis that we created a long time ago. Effectively what we did, and this is, I can't take credit for this. This is before I even came over to Baker from the FDIC. This is an FDIC analysis that they use internally to get a starting point for what a reasonable beta might be for an institution. So it's not super granular because the call report just gives us interest bearing or now accounts and then savings and money markets. But this analysis goes through 6 different rate cycles, both rising and falling, gives us an average beta. So we can see, were we pretty rate sensitive or not, given the different rate scenario?
Yeah, Dell, I want to say too, I
Yeah,
think this is a good visual representation for everyone to see just because we know there are many rate cycles. We've had many rate cycles, and generally, no two are exactly the same. So I think this is a good reminder to, consider the assumptions, the betas in this case are the assumptions you're using currently. What rate cycle might those be based on? How for this bank, why was the falling rate environment from Q2 19 into COVID, why were those betas so low versus more recently, the now beta down there on, I guess, just the 125
yep,
basis points that we've lowered. Why is that now beta higher? So anyways, I think this is a good representation to remember to consider all previous rate cycles and which might be most meaningful for the current in environment that we are in.
yeah. No,
Um,
that's a great point. And not that I need to add more, but like this is a great example. Like look at this falling rate environment that Jake highlighted. A 6% beta is low. But I would not encourage banks to go and go, oh, well, the last falling rate environment we did 6. Well, look, we're at 24 basis points and then we went to 16, right? So that's not the best representation of where we are today, right? Because the peak in rates was above 5%. And there's probably a lot more deposit competition. So this is again a starting point for the qualitative analysis that Jake just talked about.
yeah, and I
Uh,
mean, I like these analyses too because you don't. It doesn't mean it's wasted if it doesn't provide any assumptions that you can actually
yeah,
use within the model. But so it's not that you have to pull assumptions into the model based off things like these. It could just provide good color, good background, and really also too it shows the examiners that you are keeping track, and that you are on top of what has occurred, and it's all just methodology for how we actually want to model um, our
yeah.
core deep deposits in this case. It really applies to both decay and betas, I would say too. So yeah, sorry,
Yep.
Del, go on.
No, you're good. Yeah. And again, if anybody wants a copy of this analysis, let me know. This is all call report. We can run it for you. So the other thing too, again, that was call report. Probably the better approach, maybe the more accurate approach, if you will, is you provide me with your historical rates, right? That way we can get more granularity by product type. Some of you have 30 non-maturity deposit accounts set up in your model, right? Or more. So I think that's important. I think we're seeing that some of you might have betas that haven't been adjusted in a while, especially in these falling rate scenarios, and lowering them, making them more conservative, showing that you can't reprice deposits lower, that can impact your results. Maybe it's not a huge amount, but it can really drive the results and potentially swing you from margin expansion in a falling rate scenario to margin compression. So again, you can go call report based, you can go core processor download. These are some of the things that we work with our clients, both sides. And then second to last in this section, why is backtesting important? I think backtesting, I always explain backtesting like this. It's like a budget variance report. What did the model say we were going to do over the next 12 months versus what happened, right? Sometimes interest rates move during that 12 months, sometimes they don't, right? And how close was our model in projections versus actual? What's the variance or difference? And then let's have a conversation, right? If the variance or difference is small, probably don't have to have a long conversation. But if it's starting to get above maybe 10, 15, 20%, why were we wrong? Did we think we were going to make loans at 7.5%? We made them at 6.5. Did we think we were going to run CD specials at 4 and we ran them at 3 or 5? Right? Start to dive in. It is the best jumpstart for an annual assumption review. Right? Use that back test, leverage it to jumpstart that annual assumption review. It will help you identify where our model and some of the assumptions may have been off. And it's just one of kind of, we have this old iron triangle of interest rate risk validation or whatever we call it. It's kind of goofy, but back testing is one important part. The validation is another. Typically third parties like the Baker Group, we hire a third party to do that. So there's really nothing there. And then the interest rate risk process, which Jake will talk about, that's what he gets hired by banks and credit unions across the country to do on behalf of them. He's validating the process, right? And he's really getting into the entire ALCO interest rate risk process. So most of you, this is a little blurry, but that's okay. This is a sample back test from our model. It's one page. Most of you are going to get a back test from your model provider. We're comparing projections versus actual, typically over a 1 year period. Maybe rates went down or went up or moved during that time frame. And we're looking at the variance. How much variance was there in our net interest income or margin projection? Sometimes it's low like this one. This is 4.6. Sometimes it's 15. Sometimes it's 20. We want to understand what's driving it, right? Was it a balance sheet mix or volume change? Were we, like I said earlier, were we way off on how much we'd reprice our deposits or loans? Utilize the back test, not as just a check the box activity for the regulators. Use it to jumpstart that assumption review. All right, current rate environment. I just want to throw in some stuff about the current rate environment, right? I mentioned earlier, I think we are all probably on the same page. We see a path to lower rates. The speed and magnitude is going to be determined by data when we get it, again, with the government, and how well the economy holds up. Here's a sample client of ours that we started working with a couple of years ago. They're a little bit larger bond portfolio, loan portfolio at about 43% of assets, but they're also holding a lot of cash, right? About 15% in cash. So just to give you a little color, I'm not going to say who this client is, but this was a client that was concerned about liquidity. They were concerned about the regulators being concerned about their liquidity. They were concerned about the deposit pressures. So they increased the amount of cash liquidity they had, really from about Silicon Valley Bank's failure to last a quarter ago. So they built up their cash position. They had a lot of variable rate loans, and they had some variable rate investments, some floaters. And so, again, they did very well when rates rose. But now with the transition to this falling rate environment, they started to see a lot of negative numbers, a lot of projected margin compression. in their earnings simulation. Okay. Floating rate loans. Yes, some of their loans had floors, but they're still 200 or 250 basis points from hitting that floor. Maybe the floor is at 5.5, 6. So there's risk there. Those floating rate securities, again, kind of a hedge, but they don't do as well as rates fall. And then more specifically, their cash position. 15% cash, cash does well when rates go up, does not do as well when rates fall. So you can see that this is the broader point of what I wanted to make in this section. A lot of your alcos and a lot of your boards are used to getting these summary type of reports. This is our summary asset liability mix page. I show it on every alco I do. This is our 12-month earnings horizon. I show it on every alco that I do. This is one I don't always show, but I encourage you guys. I know you don't all work with us, but whatever model you work with, find out what's driving your risk. Is it too much cash? Do we have a lot of variable rate loans? Where are our floors? How does our bond portfolio do if rates fall, right? Dig into the numbers a little bit more, right? That doesn't mean you have to look at all 150 or 200 pages of your ALM model, but occasionally have a pointed conversation. Sprinkle in a detail page like this. Understand what's driving our risk. How do we mitigate that? Do we need to take some of this cash and buy bonds, make loans? Obviously, if we're banks, credit unions, like we want to make loans, but if we don't have the loan demand, then we got to look to the bond portfolio, right? We got to look to the right types of bonds for the type of environment. This is more of a resource slide. There's a lot in here, but these are the types of strategic conversations that we're having with our clients, and I encourage you guys to have at your alcos. Don't just use the alco as a check the box activity. We want to make strategic decisions to try to reduce the amount of interest rate risk that we have on the balance sheet while keeping it within these policy limits, right? And so, these high rate peak strategies, we change what we do with our investment strategy, right? We make a written investment strategy for our clients every quarter, and it changes. It changes when rates are falling, when we're at or near the peak in rates, and you can kind of see how some of these high rate strategies sort of transition, right? And that all goes back to understanding your risk. What's driving our risk? Is it being driven by the loan portfolio, our cash liquidity position, our existing investment portfolio, or a combination of all three, right? So this is a great slide to kind of talk about ALM 101, how the bond portfolio we feel is the best tool to control and correct and improve our asset liability management exposures. All right, I'm going to get through this very quick and then give it to Jake, and he can kind of wrap us up. But in honor of the theme Nightmare on Yield Street, again, credit to Saltmarsh Marketing, genius, I love it. Let's do a little case study. So this is a bank that kind of flew under the radar. It failed about 18 months ago out of Pennsylvania, about 5.8 billion in assets when they closed. I say they flew under the radar because they weren't the Silicon Valley Bank or the Signature Bank or anything like that, but they were Republic First Bank, not First Republic Bank, but Republic First Bank. They failed in April of 2024. I want you just to look at some of their data. It's pretty wild. You look at some of their numbers. Asset quality looked good, right? Not your typical asset quality related loan loss failure. Liquidity, for all intents and purposes, liquidity, some of these classic measures of liquidity, on balance sheet liquidity looked strong. Interest rate risk looked poor. Too many long-term assets, depreciated bond portfolio, declining margin, declining performance. So their liquidity and interest rate risk problems manifest into an earnings and capital problem. And ultimately the bank failed. Look at their margin, the last call report they filed. That's not a misprint. That's 87 basis points of margin. So for years they were in line with peer, a little underperforming. Then COVID, they made a lot of mistakes, right? One is they really underestimated how rate sensitive their deposits were. So deposits started outflowing, cost of funds exploded, right? And that cost of funds exploded alongside their yield on earning assets were locked out. They made too many long-term loans. They bought too many long-term bonds. You put that together in a rising rate scenario, it's just an absolute disaster, right? And you can see that they grew the bond portfolio, bought the wrong types of bonds, added way too much duration, You can see this also. Look at this. This is long-term assets. Assets that cannot reprice or assets that reprice or mature greater than 5 years. Both loans were too long and securities, and it was just an absolute mess. So, all right, I'm going to hand it over to Jake. He's going to talk about kind of his side of things on Salt Marsh.
Okay, thank you, Dell. That was great data, great input. I'm going to wrap things up for us. And I guess you already mentioned it, Dell, but I'm an interest rate risk nerd. I love doing this. I love seeing different banks' balance sheets, seeing different models. My background being in modeling, that's one area that I am pretty passionate about. I think you've already, yeah, Dell mentioned this once, but I'll say one more time. When it comes to modeling, it really is garbage in, garbage out. So I like digging into it, looking at all those variables, assumptions, and results, and kind of seeing how, I don't ever go into a review thinking a model isn't right, um, or that there is something to fix necessarily, but there's just, you guys know this, there's so much going on within these models. Most report packages are at minimum 100 pages, at least 80, 100 pages. Some get over 200, 250. Dell mentioned the detail reports versus the summary reports. I like getting into all of it. So, um, as you know, the internal auditor side of me likes verifying all of that. The audit procedures here that I have listed out, I'm generally going to start a review by looking at your past exam, and also looking at some previous, years of the model and kind of seeing how things may have changed for you over the past year, 2 years, um, and just make some general observations, changes. Not all of that is going to make the review itself, but I will definitely have a talk. And that's another aspect of this review process that I enjoy. It's just working with you guys. Um, hearing about the
Hey
risk that's
Jake,
on the balance sheet, what you're most concerned with. Sorry,
Jake,
Jason.
can you hear me? Sorry, I know we've got just a few minutes left, and
Sure.
I don't want you to miss out on maybe that last slide, Dale. If you want to kind of
Okay.
jump to that one, I just want to
Yeah.
make sure folks don't leave before they hear your brain on this stuff real quick.
Frequently found recommendations. Yeah. I guess, yeah, this is the list that I kind of came up with. This is what I see most often. Uh, you know, not all of these recommendations are going to make the actual report as like a formal recommendations. We separate those between low, medium, and high. I'm also going to share verbal recommendations, best practice ideas, suggestions, just areas to enhance your internal process and modeling of overall of effectiveness. So when it comes to policy, the policy is going to provide our framework for just the overall management of the balance sheet and rate sensitive assets and liabilities. When it comes to ALM and IRR, we want to avoid tunnel vision, I would say. We want to avoid just the act of checking a box. And I think kind of the first defense against that is just a well-written policy that you can always go back to, look at. You're obviously going to want to review the policy at least once per year. But these are just a list of policy enhancements that I'm suggesting most often. I want to highlight there third when it comes to procedures and the yes, yeah, sorry. When your NII, your earnings and capital at risk limits are out of policy, you always need to have a good idea of what you want to do with those. Right in policy. If you're not concerned with your EVE being out of policy in a plus 400 shock, then make sure you've written down that as long as you talk about it, if ALCO and board doesn't foresee that rate scenario as viable, this is how you want to handle that out of policy limit. Versus we want to handle this out of policy limit that is more realistic. Maybe, we want to make an action plan for how we might want to change that, how we might want to bring that back into policy. And then the requirements for testing, back testing, and assumptions, that is always a good one that every policy really needs. Minutes, always encourage keeping good and detailed minutes. I've listed out some detailed documentation of out of policy limits, performance trends, net loss scenarios, really anything that is discussed within those meetings and is relevant. Let's get those into your minutes and do that on a regular basis. Along the same lines as what Dell has already talked about, model assumption refinement is always going to come up. That's just kind of an evergreen area that could always be a little bit better. With all of these here, I want to encourage in the current rate environment with falling rates on the horizon. Let's look at the previous rate cycle lows of, say, late 2021, early 22. I think the first rate hike was in March of 22, maybe. So in that period post-COVID, let's look at how the bank performed. If deposits were, if your money market accounts were at about 50 basis points then let's not model now that in a down 400 rate environment that those core deposits would go beneath 0.5. Let's never let those go to 0.05. Let's always make sure that our model results are realistic and relevant. Lastly, alternative assumption and sensitivity testing. Dell also mentioned, we mentioned best practice, doing that on a regular quarterly basis. The absolute minimum is doing that at least once per year. That is a medium priority recommendation that I've made several times. I think sometimes you just forget to run those. So definitely get those on the calendar, get it in policy. And then just remember to talk about those results in minutes. And as Dell mentioned too, we want to test earnings and capital impacts of relevant. We want to make relevant tests here. We want to lower our deposit beta factors as rates fall so that we don't have any savings there. If you have a lot of time deposits, let's make sure that you are testing those betas too. If you had a lot of surge deposits during COVID, then let's see the impact of what might happen if those were to leave the bank and you had to deal with that. So we'll make this list of available as this whole presentation is. So that you can reference it. But yeah, this is just, I've been a Salt Marsh about 1.5 years now, and during my time, this is definitely the list of what I would call the most relevant recommendations and recommendations that I'm bringing up the most right now. So thank you for bearing with us through all that. We made it a little bit over an hour. Hopefully you like interest rate risk as much as we do.
Thanks, Jake. Thanks, Dale. I think you can tell they mentioned being interest rate risk nerds, and I believe they could have talked to us for 5 hours. No need to worry about, do we have enough? I think we could have a lot of material longer, right? Thank you all for joining us. If you have any questions, please reach out. Let us know. We'll be glad to answer them. We'll get them to the right person, get them answered. But we really appreciate your time, and thank you.
Yep. Thanks, everybody.
Bye.
Thank you.